there's real diverse spreading around, if you will, of the assets. Obviously, there's people, chasing tech. I don't think you necessarily need to chase tech. You could buy a broad market ETF like the S&P 500 and still get pretty good tech exposure, but not have all your eggs in that basket. Our flows continue to be leaning towards value. Small cap has been a real big surprise for us here lately. We do have the tech side of things. We've got a data and infrastructure product. So I think we're sort of where we were last year, which is a little bit puzzling to me, because last year at least we were coming off of really an obliteration in the tech names, but we're still stuck in the same place. We're looking at interest rates and what the Fed's going to do. We're trying to figure out whether they've actually done their job and destroyed the U.S. economy. I'm sorry, not destroyed the U.S. economy, but cooled things down inflation-wise. And then, earnings are always going to be the issue going forward. I'm not as impressed with people beating their earnings as I am in what they're forecasting is going to happen. Mm-hmm. And when you have these reports like you got out of Palo Alto last week, where they sort of tamper things down, I think we're at a level right now where the market's priced overall a little bit on the high end. And so, we have to be very, very careful about bad news.
I mean, you made the joke about destroying the economy, but man, that data continues to hold up really, really well. Is there a reactive sense to ETF flows, like big reversals that are happening? And I guess I'm just trying to understand where the biggest misprice is. If inflation kind of eventually keeps coming down and the data still stays okay.
That could be what happens, Alex. You could actually, they might not actually destroy the U.S. economy. They might do it perfectly, right? They may have gotten inflation under control without, having unemployment spike and without having a major impact on, everybody's earnings. I think the interesting thing that's happening right now is that, and I think you need to keep an eye on that, is look at layoffs. I mean, we're starting to see somewhat of an acceleration. So I think companies are starting to think to themselves going forward, how do I increase my earnings? Well, one way to do that would be on the cost side of the ledger. And so as we came out of COVID, that was the big spur that got the big tech names going, is they were over, weight, if you will, employees, and they started to cut back, and that's sort of what juiced their returns. And I think you're starting to see that go sort of a little bit more broadly across the board.
Hey, Sean, you say maybe one of the ways to play AI is through the picks and shovels strategy. Talk to us about how you'd get exposure that way.
Well, we have two strategies there. We own the data centers and the cell phone towers. And so you can't have AI streaming, Internet of Things, e-commerce, and online gaming. You can't have that without the buildings that essentially allow for all of the transmission of the data. So that's one way to play it, would be to buy data centers and cell phone towers. We have an ETF that does that, the ticker's SRV, our server. And then the other way to do it is to play, if you will, the software names and the chip makers. And those names are, basically the NVIDIA is in that mix, but it's not all about NVIDIA. There are a lot of companies in that space. And so we have an ETF that TRFK, traffic, that basically takes everything out of the data centers and says that's what we own.
When you talk about alternatives, we were talking to Kathy Entwistle in the last hour about alternatives and stuff. We'll throw Bitcoin in there. Let's throw some REITs in there too. What other kind of alternative ETF flows are you seeing?
Well, we have an income story that we like that's starting to pick up some steam. Essentially, its target is to get 4 times the dividend of the S&P 500.
Four times? Okay.
4 times, yes. The ticker's QDPO, get it, quadruple. And the way we do that, the way we do that is about 86% of the money is basically in the S&P 500 and 14% of it's in T-bills. And those T-bills are used to enter into futures contracts on the dividends. And so we're able to pull forward 3 times, or a little bit more than 3.14 times, this year's dividend by using those futures. And so it's really done exactly what we've expected it to do. And with all the emphasis, for example, on covered calls, with the success of some of the big players in that space, we think the limitation on covered calls is that you're selling away your upside. And with the strategy like this, you don't sell your upside away. So we're starting to see some interesting flows in that area as well.
Sean, how do you compete in this market that's so dominated by just literally a couple of 3 or 4 kind of ETF providers here? How do you kind of compete and set yourself apart?
We like to say innovative, disruptive, and unique. That's what we build. So our neighbor at home in Malvern, Pennsylvania is Vanguard. We know who they are. We know what they do. And we know that we're not ready to stand toe-to-toe with them, if you will, and fight it out on cost. We'll let State Street do that. So we build strategies. We build an end user in mind or an outcome in mind. Maybe that's excess return, or maybe that's risk management, or maybe it's something like the Count series that just takes a completely different look at the way you define value in this world. Instead of using traditional price to book, we use free cash flow yield. because the stock market is primarily intangible assets today. And so that's what we do. And so we've been able to accumulate, I think, a reasonable amount of assets, around 40 billion right now. I think there's a lot of room for us to grow. And, if you're innovative and you're disruptive and you're unique and you have a sales force like we do that focuses on the financial advisors, you can continue to build a nice business. I don't have to have a $5 trillion business.
Yeah.
I just need to keep growing it like we have been, and we'll continue to do that, we hope.
I really want to have the job where you get to come up with the names for these things, like the tickers for
Yes.
it. I want to do that. That sounds like a good time. Before we let you go, it's not just U.S. that have been doing really well, right? Japanese equities, Nikkei, record high. The CAC, the DAX, record highs. What opportunities are you seeing internationally?
Well, we missed Japan. We probably should have had a product there, because whenever Warren Buffett starts to move in an area, it's probably good to pay attention. And so he's increasing his exposure there. So he's probably right. We've seen a pretty big increase in our global and international. My favorite story, and it may take patience, I'll just warn all the viewers and listeners, is emerging markets. I mean, we have an emerging market product that has like a 9% current dividend. And it's 100 profitable emerging market names. And I think that cycle has gone on too long. It could continue for a while, but sooner or later, the emerging market cycle will change. And if you think about historically how they do relative to U.S., over time, they do better. It's just been a currency problem here lately. And so for long-term investors, maybe you tuck a little bit of money in emerging markets.